Okay, Josh. So, partnerships and the liquidation. So the first thing you have to look at is that you always have to remember, we assume that the partners are insolvent in their personal capacity. Thus, they would not have any cash in their bank account to pay the partnership if they owe any additional funds other than that which is already in the partnership. In other words, the only money they have is which you can see in the partnership. And then another important fact is to remember distributions of cash are not made in the same relationship as the profit ratio. As we go through the example, you'll see what I mean by. Okay, and then just another simple point to remember, you cannot make a distribution to an partner if there is still a risk or there's a remaining risk that this partner's account could go into a debit after. So the example that we have here, we have Promise and Pine and Patrice, which share in the partnership at a ratio of 5:3:2, Patrice being the highest, Pine being middle, and Promise the lowest. Normally, one would like to distribute the 4,500 Rand they have in cash at the bottom of the picture in their normal profit ratio. But this would be incorrect, as there still is a remaining risk that they could realize a loss after this distribution. So I'm guessing I've lost you. And how are we looking? What do I mean when I'm telling you there's a risk of loss? So if the partnership still owns assets, they have the risk of having to impair these assets or giving these assets away, as nobody would like to purchase them, as there's no market for these assets. This would relate into this journal where you would debit a scrapping loss and credit your asset to get it out of your books, and this would lead to a loss that would have to be shared between the partners. Right. So, guessing that you're back on track, is there a risk that any of these partners' capital account could run into a debit on realization of a loss on the assets? Well, I don't know. We have to calculate that and then we check. So, we start normally, we check the balances. We have the cash at the top for 4,500. This is which we would like to distribute. But first we have to consider what happens if we have to write off the PPE that's still in our accounts of 9,900. So we calculate the risk of the loss on those assets by sharing the 495 or the 9,900, splitting it in the asset or profit share ratio. 5 out of 10 to Patrice, 3 to Pine, and 2 to Promise, giving us the 4950, the 2970, and the 1980. Subtracting this from the opening balances, you'll see we still have a credit balance for Patrice and we have a credit balance for Pine, but Promise ends up in a debit balance. This means there's a risk that Promise would have would realize a debit balance after the distribution and thus cannot partake in this distribution. So if all these capital accounts were in a credit balance, we would stop here, and this line item reading capital after risk of loss would be your distribution ratio in which you would distribute the 4,500. But this is not the case. We cannot distribute cash as Promise is going into a debit. We have to take another step and that loss. So what happens to that? Well, the other partners have to absorb it, and they absorb it in their ratio of profit share that they usually have. So all we do is we split the 100 Rand loss that Promise would have realized into Patrice's account on 5/8 and into Pine's account with a 3/8, giving us the final balances of 2688 and 1812, leaving promise of 0. And this would be your final distribution ratio, which would be applied in calculating how the 4,500 would be distributed to the owners of the pot. Right. There we have it, the final picture. You did all those calculations, and yes, you do all those calculations just to determine the one interim payment, and this will be done for all interim payments in which there is any other assets in the company left other than the cash balance. And once again, I'm just indicating later on they had a 6,000 Rand cash balance and they had a remaining 3,900. You would follow the same steps as we just did for the 4,500 to determine the loss that could be realized on the 3,900, and you would calculate your distribution ratio. That's all on this calculation. I hope it makes sense, and may there be more videos in future.